Hi, my name is Dennis Brooks. I'm a graduate student here at the University of Alabama in Birmingham in the Colat School of Business. I'm also a tutor in the Colat Tutor Lab at the Colat School of Business here. You can reach us at colattutorlab@uad.edu, or you can contact us for a Skype session at Colat Space Tutor Lab, and we'll be glad to help you in either way if you have email questions or wish for a more one-on-one Skype session. We're going to conclude today's work with a overview of Chapter 19, Variable Costing and Performance Reporting. If you'll remember, way back in Chapter 14, we talked about the difference between financial accounting and management accounting. Financial accounting is bound by the constraints of GAAP, generally accepted accounting principles. So financial accounting is primarily used for financial statement creation. Management accounting allows you to manipulate data in a way that GAAP would not allow you to help you make decisions in a better way that will not be detrimental to your company. Now, there's two primary things that are discussed in this chapter, which are absorption costing and variable costing. And then what we're going to discuss is how using variable costing will help us make business decisions at a later date. If you remember when we were talking about costing in chapter 16 and 17, we talked about direct labor, direct materials, factory overhead, and things of that nature. Well, what we're going to talk about here is absorption costing. Under this traditional costing approach, all manufacturing costs are assigned to products. These costs are direct material, direct labor, variable overhead, and fixed overhead, widely used for external reporting purposes, GAAP, but can result in misleading product cost information for managers who are internal users. GAAP is for the external user. Management accounting is for the internal user. Now, this is a method that is preferred by many managers. It's called variable costing. Under this method, direct material, direct labor, and variable overhead are included in assigning costs to products, but fixed overhead is treated as an expense and is expensed in the period in which it is incurred. In a period in which quantity produced equals quantity sold, this method of costing will produce the exact same net income for the income statement. Okay, so what that means is that if you produce 40,000 skates and you sell 40,000 skates, it's going to produce the same type of costing as absorption costing will on your income statement. However, in a period where quantity produced exceeds the units sold, net income is lower than it would be under absorption costing. What this does is discourages management who sometimes are motivated by short-term concerns such as bonuses for hitting targeted net income numbers. It keeps them from taking things and manufacturing and putting them into inventory to be counted as an asset. So net income is lower than it would be under absorption costing. That means that you made more units than you sold. In a period in which quantity produced is less than units sold, that means there had to be some number in beginning inventory that were sold as well as what was produced. Net income is higher under variable costing. The primary reason that we use variable costing is to help us when we are making capacity decisions. Okay? In this example, what I'm going to describe here, one of the primary uses for this costing method is used for figuring out if you should sell some X amount of your product for less than your usual price. This has several caveats included. It is a one-off sale. That means it's not something you're entering into a long-term agreement. You're doing this one time only for this customer. 2, your normal customers will not find out about it. Okay? So what we're going to talk about here is, says, in this instance, we're talking about your factory has a capacity of making 50,000 pairs of skates per month without incurring any increased fixed cost. So in this month that we're discussing, you sell 45,000 pairs of skates at $40 per pair of skates, and a variable cost to you of $25. This is variable costing, so it'd be direct materials, direct labor, and variable overhead. You have the capacity to manufacture 50,000 pairs of skates without incurring any additional fixed costs. This excess capacity is going to be unused, but you get a request from a company to buy 5,000 pairs of skates for $30. Now this is 25% less than what you would normally charge, but since you have $25 in a pair of skates, you should make the sale. This is one of the primary uses of this type of decision making from variable costing. And I really need to stress to you that when you're making a decision based off this model, it needs to be a one-off sale, and it needs to be something that your normal customers would not find about and go, oh, hey, we hear you're selling these for $30, now we want $30. So what you're essentially making the decision on here is whether you use that excess capacity of 5,000 pairs of skates and sell it for a cheaper price than what you would normally sell it. And again, as we discussed, because you have $25 in the skates and they offer $30, that's an additional 5,000 times, so $25,000 that you would not have made in profit. So you would make it because you made this decision, which you may not have made if you were only using absorption costing, which is considered compliant. And again, like we talked about, management accounting is for internal users only, so it is not regulated by rules such as GAAP. So again, chapter 19 was about variable costing and performance reporting. In your book, it goes through and it kind of tells you all of this, and it takes several pages to tell you that. So I've condensed it down into fairly small pieces so that you can understand what the purpose for and why you do it. Because it breaks it down, it has several different income statements in there showing where the prices change when you underproduce or you overproduce or you produce just right. And then it just discusses one of the primary reasons for using absorption costing. Again, my name is Dennis Brooks. I am a tutor here at the Colat Tutor Lab at the UAB Colat School of Business. You can reach us at colattutorlab@uab.edu, or you can arrange a Skype session with us at Colat Tutor Lab, and we'll be glad to help you in any way we can. Good luck on your midterm, and I will be talking to you some more over the next series of chapters that will conclude your finals in a couple of weeks. Again, my name is Dennis Brooks, and thank you for your attention.